was selling a 250,000 square foot industrial building. And as we're walking through touring it, came across two bodies. So, yeah, that was my first and only experience with that. But they were trying to steal the copper, and the wires were hot. So apparently, the first person got electrocuted. His buddy tried to save him and grabbed him and got electrocuted himself.
Whoa!
So,
welcome to Founders Club, the podcast for real estate professionals.
Right, George, welcome to Founders Club.
Thanks for having me, Oliver. Looking forward to it.
Yeah, appreciate you coming on. And I know that you've been in the real estate business for many, many years and have founded a very successful company. I know you've also done over $1 billion in commercial real estate deals. So why don't we start with just tell me about one of the craziest deals you've done.
Well, okay. One of the craziest deals. Well, back in the old days, actually, it's probably a couple deals. I originally started off doing real estate auctions, and there was a mall in Central California that we sold 3 times in the mid-90s, early mid-90s. Each time it was foreclosed upon, and we would take it to auction, sell it, and come back, and vice versa. But I have a ton of stories. I had I've been lucky enough to be in this industry for quite some time and had a lot of experience, both initially starting off doing the real estate auctions, but also doing bulk sales and REO stuff, and some very interesting stuff. Now on the commercial side, other than the Hanford Mall we sold 3 times, I did have a very interesting situation. One time I was selling a 250,000 square foot industrial building, and as we're walking through touring it, came across 2 bodies. So, yeah, that was my first and only experience with that. But they were trying to steal the copper, and the wires were hot. So apparently, the first person got electrocuted. His buddy tried to save him and grabbed him and got electrocuted himself.
Whoa.
So that was very interesting. Needless, and we did end up selling the building though. But that was also very interesting as well because it was quite contaminated as land goes. But via the auction, we ended up selling it pretty quickly, pretty easily, and at a decent price.
That's an unbelievable story right there. That's definitely a new one.
Yeah. Well, we've seen quite a few different things, and I've heard a lot from different agents. But yeah, that was probably the hairiest and weirdest deal ever. Most of my deals, though, are pretty straightforward, pretty simple, and for the most part, just solving the issues for the investors. And that as long as we do that, we're good.
All right, cool. And from my understanding, your expertise is kind of in the single, the net leases, single tenant net leases.
Single tenant net lease. So, a few years ago, I was actually named as one of the top 12 single tenant net lease influencers in the nation by Globe Street, and I do it a little differently. I like to represent buyers versus listings. And there are a lot of companies out there, and actually there's probably about 6 companies that really control the whole listing side. And the problem that I've always seen with that is that if you hire them to represent you as a buyer, not saying they're not good or anything, but they promote their own properties. They try and sell you what they have. And the issue that comes up is you don't see everything that's out there. So when I started buying my own properties out there, I was realizing, I'm finding better deals by just going and out and sourcing them myself. And, that's what we did with our buyers. So, we do a pretty heavy intake with our buyers to try and determine what pain points they're trying to solve and resolve and find the right property that can then fit in there. The nice part is because we've been around for a while and we have a really good track record and history, we do get some insight into some off-market or soon-to-market deals that haven't been marketed yet. Which allows a lot of our buyers to see some really choice properties. And we've been able to pick up some very prime, very nice properties. So.
Nice. Okay, cool. And then what would you say are your kind of favorite asset classes at the moment? Because obviously it's been a transitional couple of years in the real estate business. So like where are you guys focusing now? Where do you see the big opportunities?
Well, for myself, I invest in, I invest in what I know. So I do the single tenant net lease, and I'm very much, as I explain it to anyone who asks me, I am geographically agnostic, but extremely location driven. So, I've learned throughout my career, and I learned this the hard way, that don't just necessarily discount a property because it's in Arkansas. It still may be a great, incredible property with upside potential and opportunity there.
Mm.
And no offense to Arkansas, but but generally speaking, so with that in mind, the single tenant net lease. But I also have investors that are really looking at IOS, the industrial outdoor storage. That's been a really big push right now, and of course, we've seen a lot of opportunities start coming up with office right now with the back to office mandates, and we're starting to see them grow and come up. So if you're doing different type of investments, there's definitely some different opportunities that are out there. In fact, New York, just a few months ago, was the very first city to actually beat pre-COVID numbers for office occupancy, followed closely by Miami the next month. So we're
Wow.
starting to see it rebound pretty heavily. And San Francisco's actually on a big rebound as well. Not so much in Southern California yet. So, but that to me is opportunity.
Yeah. Yeah, that's interesting to hear because all the people I know that are kind of in that space the last few years have just been talking about how vacancy is a big issue and getting people to rent.
Yeah.
Um, okay, cool. So as one of the top single tenant net lease specialists in the country, why don't we just start with like what is that for the people that
Okay.
don't know, and then I want to kind of break down
Yep.
a little deeper.
Okay. So single tenant net lease is typically a single tenant in one building that leases the property, and it's a net lease, meaning that the rent is net for the landlord. They don't pay any expenses. They're not responsible for the maintenance. They're not responsible for the repairs. They're not responsible for the property tax or insurance. They're actually co-insured by the tenant. So they have no expenses coming in. They just collect rent. These are typically long-term leases, and the most common ones are fast food locations. But you also have different, within that sector, there's also, or within the single tenant net lease sector, there's also, industrial single tenant net lease. There's also medical, DaVita dialysis or dialysis companies, Fresenius, DaVita. Those are some growth industries that are also typically recession as well as pandemic resistant, or if not proof, because, obviously if you don't get your dialysis, you die. So that's a business that can come in and go in. So we see all these different types of businesses. Gas stations, actually gas stations and car washes right now are the belle of the ball because the one big bill that was just passed in May, which allows for 100% bonus depreciation. So, in theory, you could buy a property for $3 million and have a $2 million write-off. And if you're a real estate professional, that can go right to your income. If you're not a real estate professional, you have to write that off toward your passive income.
Yeah, no, big opportunity there for sure. So basically, it is owner of a building
Mhm.
that has no responsibility outside of just collecting the rent, and the tenant is responsible for everything else.
Correct. Correct. And usually those tenants are credit type or stronger tenants. They're not your normal mom and pops. I mean, there are single tenant net lease properties that have mom and pop operators. That's typically not what I deal with. I typically deal with more of the investment grade properties. So we're dealing with companies that can be, McDonald's, for instance, or a Raising Cane's, or, like I mentioned, DaVita. It can be anybody along those lines, even Microsoft in some cases. So you see these and, or any kind of retailer for that matter. I just sold a REI recently. So those are the bigger boxes. You have Best Buys, things like that. So you have these credit guarantees or credit tenants that are guaranteeing the rent. Many times are actually sometimes, rated higher than some banks that are out there. So you're getting some really good credit tenants, but you're getting a good income on it, plus the depreciation benefits.
That's interesting. And so are these just traded on the regular market like every other deal on the commercial side of things? Or is this like
Absolutely.
a specialized like sub two, you got to kind of find it sort of a thing?
No, it's traded within the commercial market just like any. In fact, single tenant net lease is considered as one of the most liquid forms of real estate because there's almost always a market for it. So, it's a very quick liquid market as long as you're pricing it correctly and moving forward. There's always buyers out there, whether, sometimes it might be a buyer that is older looking for asset preservation or cash flow without having to worry about the management or risk of having a tenant that goes dark or bankrupt. So, they're putting their money into that, because they're outpacing what the bonds are doing. And on top of that, you're still getting tax benefits.
Yeah. Yeah, no, I hear that. Okay, so interesting. So you can, and how are you finding them for your buyers? Do you source off-market deals, or is
Yes.
that through broker relationships, or where are you finding these deals?
Well, a combination. Number one, first and foremost, we look and we search different databases, the commercial databases. We belong to quite a few. I have a team here that we look at probably 100 to 120 properties a day. We vet those out. We find maybe 5 properties a week we really like, 5 or 6. In addition to that, I have a network of brokers from all the listing companies that I've done deals with for the however many years, that literally they sometimes reach out to me saying, hey, I have new properties coming up. Here's what they are. Or other times I'll reach out to them and say, I have a new client. Here's what I'm looking for. What do you have coming up that's not on the market? And they share that information because I luckily have a pretty good track record.
Yeah, yeah, no doubt. And then how are you underwriting these deals versus traditional sale?
Good question. Number one, taking out the price considerations, because, each tenant trades at a different cap rate based on, it's all about risk versus reward. But what I put most of my underwriting into is actually location. I'm looking at not what this property, my very first thing I look at is not the property, what it's generating, but what happens if that tenant leaves. How can I improve it, and can I improve it, and where can I improve it, and where can I go? I have 6 assets right now we're sitting on that the best thing to happen is if the tenant goes bankrupt, because I can re-tenant it at a much higher rental rate and with a better tenant and increase the value that way through the cap rate. So that's what I'm looking for, is those irreplaceable type locations. For instance, I had a client that we acquired a Chase Bank that is catty corner to the Dallas Cowboys stadium.
Nice.
Okay. Best thing could happen is that bank goes out of business, or they
Yeah.
close, they want to go dark. Because I could put a C-store, I can put a 7-Eleven in there in a heartbeat at 1.5 times the rent. And 7-Eleven actually, because they're AA- rated on the S&P, they actually trade at a better cap rate than the bank. So I'm going to be able to increase the value that way as well. So those are what I look for. But then from there, if it passes that sniff test of like worst case scenario, am I stuck with a vacant property that I'm just going to sit here forever with? No, great. I can re-tenant it. Then I start looking at, well, what's the price is it worth today, based upon who the tenant is, what the lease term length is, what the traffic counts are, what the demographics are, how the demographics are they growing, are they low, are they growing, or are they stable, or are they declining? So all that plays a factor into what kind of underwriting that we're doing. So we're really underwriting the actual property itself. The financial side is relatively easy.
Yeah, and what I keep hearing you say is that location is is the critical piece there. You're
Yeah.
going for
Well,
prime locations. You're location agnostic, but you like a good location.
geographically agnostic,
Yeah,
location.
yeah, yeah.
But,
Yeah,
I think
exactly.
that's actually one of the biggest mistakes a lot of the first time investors make. And, they go in looking just at a high cap rate and they think, oh, I can buy this DG or Dollar General at an 8 cap. And meanwhile, as opposed to let's say Wendy's or a Burger King at a 5 or 5.5 cap. So they're thinking I can make that much more money. The problem is it's good for while you own that property for the initial lease term, but typically speaking, they will come back hard on the renewal because a dollar store doesn't necessarily they're not a location driven concept. Their clients will drive an extra mile, 2 miles, go out of the way to save $1. So they don't care where they are. And so that puts all the leverage in their hands versus the landlord's or the owner's hands when it comes to renewals. So that property will actually decline in value as that lease term goes down. And that's typical, but there are ways to mitigate that and to go in. So, if I know I have a very strong location, if I'm planning on selling it, I just reposition the lease and go in and offer a new long-term lease because I know that location is so great. The tenant doesn't want to take the risk on of waiting to, when their options are over to not have that space. So I can do an early renewal, create a long-term lease. I did that with a Del Taco up in Hesperia, where literally, it only had a few years remaining on the lease, but we ended up acquiring it, talking to Del Taco Corporate, and they said, well, why do we need to renew right now? And I said, because I'm going to make it really easy for you. We're going to keep the exact same lease. It was a percentage rent clause. You guys are doing 150% of sales for over your average normal Del Taco over the industry of their average. And because of that, you don't want to lose this location. And they're like, okay, and what do you want then? I said, well, since you're paying percentage rent, I just want you to raise the base minimum to what you paid last year in percentage rent. And then you keep the percentage rent clause, but I want a new 15-year lease. And then on top of that, I want you to commit to at least a $200,000, $250,000 remodel of the location, which is a win-win because typically when a QSR or a fast food location remodels, they typically have a 10 to 20% bump in sales. So since they're paying percentage rent, that's good for the landlord. It's good for the tenant.
Yeah.
More importantly, we acquired that at 1.6. We sold it for 2.6 in a year by just readjusting the lease.
Love that. What a great strategy. And I like how you build in also that they have to do a renovation, because I think that was going to be one of my next questions is if they're locked into these long-term leases and their location starts getting a little dusty and a little crusty, there's no incentive for you as the landlord to go in there and upgrade anything. So how do you keep it looking fresh? But I guess upon renewal or sale, that's an opportunity to do that.
Well, it's on renewal or sale, but also what's beautiful about the single tenant net lease is a lot of this is retail. So it's different on the industrial side, but on the retail side, you're very much co-aligned with the tenant because the tenant wants to make sure they understand that if the restaurant's dirty, broken windows or graffiti, they're going to have less business. So they understand that. And in fact, there are many times where if it's a large franchisee or corporate store, the corporate locations, when they do a redesign or remodel, they just remodel it. They are going to go in and they're going to put that in, even if there's 5 years remaining on the lease, and that's it. Their expectation is we're going to do this to maintain for the next 5 years, but also, we put some CapEx into the property. Hopefully we'll get a good lease term, long-term lease on that as well. But it shows their commitment to the site. And that's very common within this industry because unlike let's say a renter of multifamily, a renter in multifamily doesn't really care if the faucet's leaking because they're not paying the water bill.
Yeah.
So you may not find out about it until you tour it. But the tenant who's paying all the bills does care. And so you're very
Makes
much
sense.
aligned with it.
Yeah. Yeah, no, that makes total sense. Um, yeah, when they're on the hook for the bill, things are gonna get taken care of quicker.
Yep, exactly.
Um, and then in terms of these leases, uh, talk to me about when you say long term, are we talking like a decade, 20 years?
Well,
What are we talking? What's the
typically speaking,
typical?
initial terms are 15 to 20 years with 3 to 4 or 5 year options. So they could potentially
Wow.
go out to 40 years.
Wow.
In some cases, you may see in certain states like California, you'll see it 39 years because a 40-year lease actually triggers a reassessment, property tax reassessment.
Of
So
course it does.
yeah.
Okay, cool. And then when do these properties become more valuable or less valuable as they get closer to the lease expiring? Because what I'm hearing you say is when the lease expires, if they move, then you gotta maybe have you gotta freshen it up. But if not, um, and you can increase rent or find a new tenant, like, is that the bigger opportunity or is the bigger opportunity to just keep them there as long as possible?
Depends. And that's going to
Okay.
be that's a location driven site. If you've done your homework well and if you acquired the property right and the location is a premium location, it'll actually go up in value closer to the end term of the lease. That being
Okay.
said, if it's just your average location, typically speaking, what you're also buying is you're not just buying the property, you're also buying the credit worthiness of the tenant and the long-term stability of the cash flow.
Yeah.
So as that cash flow stream is shortened, the value drops.
Okay.
So that's why whenever a client says, well, what do I do when I go to sell? I said, well, you call me first and you don't have to use me, but I'll give you the advice to reposition that property and how to reposition it to maximize your price. That may be it's counterintuitive, but sometimes offering a tenant a discount in the rent in exchange for a long-term lease will actually increase the value. So if you're going to sell, you're trading a little bit of cash flow for 6 months by repositioning the lease, offering the tenant a discount, but because you have now a long-term lease that's 20 years versus 2 years remaining on the initial term lease, that cap rate can really compress by 150 basis points.
Yeah. Yeah. Okay. And then what is like the exit strategy on most of these deals then? Like when people buy them, obviously it seems like the most appealing part is the virtually no maintenance or problems you have to deal with. And then two is guarantee in air quotes of
Yeah.
long-term tenant paying rent that you don't have to worry about.
No, absolutely. I know. I mean, the guarantee air quotes is absolutely correct because I think everyone my age remembers Blockbuster.
Oh yeah.
And how quickly they were, and every landlord wanted them, and how quickly they disappeared.
Mm-hmm.
So, just because they're a large corporation doesn't necessarily mean it's going to be a long-term viability. So that's actually part of the underwriting that we look at is actually the business model of the tenant as well. So we're taking that into consideration. Like, how is that going to, like I mentioned, the dialysis companies, they can be really good because, again, especially when you have certain types of states that they call con states, certificate of need, meaning that a dialysis company cannot build another dialysis center until they prove to the state that there's a need. And then the state will then issue a certificate of need. So as long as you have them in that space, they can't really move.
Yeah.
And if they need 10 extra beds, they can only build 10 extra beds. They can't build if you had 20 and they can't build a 30 because the state's not going to give that. So there's actually some protections in there for the landlord in those type of situations. So we're looking at all of that to take a look to mitigate the risk. There is always risk in any kind of investment, but generally speaking, a lot of people buy it. Depends on the investor profile. I have a lot of clients that are older. that are either exchanging. A lot of them are exchanging from multifamily because they're tired of having to deal with the headaches of dealing with the tenants all the time, and then going into something like this where it's literally a set it and forget it. And they think, okay, I'm not going to have to worry about it for 15, 20 years. And then I have other investors who are a little bit more along myself, where we're looking for properties that are have either a huge tax benefit or a potential for repositioning early on or later on. And, and that's just site location, really looking at that.
Okay, makes sense. So that's like the value add model.
Absolutely. Absolutely. And
Yeah.
that's what we do. I mean, I'm working on finalizing a deal right now where we have a property that's in an infill major metro. I had a bank that was going dark at the time. When we were acquiring it, actually, they were going dark. So we renegotiated the price. They just announced that they were going dark when we were in escrow. And we renegotiated the price, raised the cap rate quite a bit. But at the same time, it's a large national bank, one of the largest in the United States. I had 8 years remaining on the lease. So they're going to have to pay rent that entire time, even though they're not operating. In the meantime, that to me was opportunity, because I now have 8 years to pick and choose who I want as my tenant without ever having to worry about loss of income. More importantly, if I find a tenant sooner, I can approach the bank and say, I'll let you out of the lease early if you give me X amount of money. So right now, we're working on a deal where I have a national credit tenant that is going to take the location, replicate 95% of the rent roughly that we're getting with the bank. But because it's a new long-term lease and a national credit, the cap rate's going to go down. So I'm immediately going to get about a $800,000 equity jump in the property from where we purchased it and where it would be. More importantly, I also have the bank now offering me approximately $650,000 to let them out of the lease early.
It's a great way to double dip.
Absolutely. So that's, I mean, that's, and all that, but you can't do this without, if the location was not strong.
Yeah.
Yeah,
that to me is the thing that keeps standing out of this conversation, is having a strong location.
absolutely. And I think that's the art in the analysis and the underwriting versus the math and the, science of it.
Yeah. And then how are these deals getting funded mainly? Is this like a 20% down commercial loan? Are these mainly cash deals? Is it seller financing? Like what are you seeing for the most part?
Not seeing seller financing that often, but typically speaking, it's either there's financing, which is typically going to be about 35% down for most commercial type loans. However, certain credit tenants, they can go as low as 20% down or 10% down in some cases. When it depends on the type of tenant, the length of the lease, and the property itself. But generally, there's financing involved, or it's all cash.
Okay.
So we have a lot of all cash purchasers, especially in the older sector, the people that are looking to retire and put a safe haven for their a relatively safe haven for their investment money, but also gain, a 6.5-7% return, better than what you're getting at the bank, plus the tax benefits.
Yeah, the tax benefit as well. And I'm sure in the lease, there's a built-in increase with like 4% a year. Is that kind of pretty standard?
Standard's typically about 10% every 5 years.
Okay.
Which equates to about 2% a year. The reason for that is, and people always say, well, is that really keeping up with inflation and whatnot? Well, you're not. The biggest issue with inflation is the expense growth. If you're not paying the expenses, then you can afford to give away a little bit more on the rent growth. So
that makes sense. Yeah. Yeah, you're not doing repairs, you're not fixing anything, you're not doing any of that.
Right. If the property taxes go up, it's not my issue. It's the tenant's issue.
Yeah.
If the when it comes to, if I'm not paying for the water. So when water bills go up or insurance goes up, insurance has been a big factor in multifamily right now because we're seeing, at least in California and across the nation, insurance rates in some cases doubling and tripling. Well, if you're a owner of multifamily, the owner's eating that. Meanwhile, you're still, you're only getting a 3% increase on your rental rates and potentially lower in some rent control markets.
Yep.
You're not keeping up with, you're actually losing money down the road.
Yeah, no, I think that's a really fair point. I think that's makes sense. So there's no expenses like as the owner of one of these, like do I have to keep insurance? What are my responsibilities other
Your
than just owning it and collecting checks?
Couple things. I always say that your main responsibility is one, to make sure that the insurance is renewed every year and that you're covered, meaning
Okay,
the insurance is actually under the tenant's name, but you are co-insured and you're the loss payee.
got it.
In addition to that, I recommend that you go out to the property at least once a year to make sure they're maintaining it. Even though they're co-aligned with wanting to maintain it, you want to make sure, because the leases have protection clauses where if you go out there and you see some deferred maintenance, you can just contact them and let them know, and they'll go out and fix it. Because sometimes, the corporate may not understand or know what the local manager's doing, and they may not be maintaining it as well to corporate standards. And the corporation is actually very happy when you let them know. So those are the things I would do. In addition to that, as far as expenses, only expense that you're going to really have is your below the line expenses, such as your accounting costs or your LLC costs, which really aren't property level. They're below the line on the NOI. So they're more about like, I create an LLC in each state, to protect myself. I obviously have to pay my accountant to do the taxes. Those are the only expenses.
That's amazing. That's terrific. So what do most people get wrong about single tenant net lease deals?
Chasing the cash flow and not the property. That's the biggest one I think that they're running into, is they think that there's a reason why a Raising Cane's in Colorado may trade at a 5 cap, but if it's in Los Angeles, it's going to be a 4 cap, or because of the location and the barriers to entry, things like that. But people just look at it sometimes as, well, what's the highest cap rate? It's the same tenant, doesn't matter. Meanwhile, you're in some tertiary market in the middle of the Midwest that if they leave, or you're stuck. The other thing, I think the biggest mistake is a lot of owners do not contact a broker for advice when the tenant reaches out to them. Meaning, as a course of business, there are certain companies out there, and quite a few, that will consistently reach out to their landlords and say, I'm having a problem. I need you to lower rent, or I need you to waive that rent increase. And the landlords are afraid to, like, oh, I'm going to lose that tenant. So they're going to go out and agree to that. For instance, I just had a client recently that reached out to me, and they have a Starbucks in Oklahoma. And Starbucks reached out saying, the lease is coming due. We want to renew the lease, but we're not going to exercise the option. We want you to just give us the same rental rate without an increase. And in fact, we're going to ask for a 10% discount on the rent. And my client called me and said, well, what do I do? And I said, well, let me do some analysis and I'll find out. So I ran with some of my tools. One of the tools that we have allows us to see what kind of traffic data we have going into the site location. I'm sitting there, I'm looking at it, and I'm like, they have over 28,000 visits right now, and per month. This is 1.5 times more than the average in Oklahoma. They're only paying on average currently 70% of what they're paying on average in Oklahoma. And this is more of a prime location than some of the other tertiary. This was in Oklahoma City versus in some of the smaller towns.
Right.
And so, my advice was tell them to, politely tell them to go pound sand. No, we're not going to do it. Or tell them that we're happy to give you an extended term, but in exchange, we want a higher rent. And see what they say. And they actually came back and said, we're just going to exercise the option. Thanks. And with the increase. So, they were sitting there and they're fine, because when we did the analysis, we realized that they were already underpaying for what they were getting.
Yeah.
In addition to, we had a very similar situation where a bank had in Chicago, a property I sold had a 10 years remaining on a term. It was a bank-owned property, bank-occupied property, and they had a one-time right to cancel the lease on year 3, early termination clause. Well, year 2, they reached out to my client after he bought it, and they said, we're thinking about canceling the lease because this one, our rental rate, we're not doing as well at this location as we thought we would. And if you can reduce the rent, we'll stay. And that's just their course of business. So we came back with, I came back with, well, let me do an analysis. FDIC has deposits, track records, history. They also, I can compare it with every other bank in the location. I realized that branch owned 40% of all deposits within that submarket. They weren't going anywhere. We came back to them and said, and my advice to my client was, try this instead. Tell them that we'll let them out early because I think I can re-tenant this faster and at a better price. And so call their bluff.
Little takeaway.
You know what? If you want to cancel the lease, don't wait till year 3. We'll let you cancel now. They came back 2 days later saying, oh, that was the wrong property. We do want to keep this lease.
Nice.
So, the biggest mistake I think that a lot of clients or owners make is that they don't look for the advice from their brokers or use their brokers. They're just worried that, they're going to lose that tenant. And that's not necessarily the case in many times. And I've done this multiple times where it has more often than not turned out to be a win for the owner and the landlord versus a concession given.
Great. Yeah, trust your experts. That's always the lesson.
Well, we have tools that a lot of people don't have access to.
Well, yeah, on that note, I was going to ask you, what are some of your kind of favorite tools that you're using on a daily basis to run the business?
Well, I mean, you have. I like some of the AI tools for site location. Like you have Placer.ai. I use that more for leases on the renewals because it gives me insight into how many people go to that location. So with that, if I know what the average ticket sales are, I can then extrapolate what their annual gross sales are. I also know that every single tenant's rent to sales ratios that they target. So I can then say, I can push that rent here, or maybe I can't be as aggressive and do it here. So I love using that. There's also MapSot, which is very similar. And, so it varies. So those are my 2 favorite ones, though, really, to be,
That's great.
Yeah.
Yep. Yeah, if you can reverse engineer that from knowing their sales targets, knowing their price, and, reverse engineer backing that into how much they can afford to pay for rent.
I can usually get within 95% of what their actual gross income is. I mean, we had a tenant just reach out recently that said, they were sitting there going, well, we're having a difficult time. We're asking for a rent reduction. And honestly, they probably are. But at the same time, I'm running in going, well, because a lot of times, sometimes the leases have sales reporting clauses, sometimes they don't. So, I went in, typed in location site, did analysis very quickly, extrapolated based upon average sales per customer, which every company publishes. And then I was off by, I think, 75,000 approximately in
That's
annual
great.
sales, and that was annual sales of about 1.4 million. So
Yeah.
yeah,
Pretty darn close.
close enough to be in the ballpark to know
Yeah,
what I can.
exactly. Yeah, I hope you all wrote that down because that's a really good strategy right there.
Yeah.
All right, and one question I kind of like to wrap up with is in 60 seconds or less, what does it take to be a good single tenant net lease specialist or investor?
You know, in 60 seconds or less, I would say that really look at it as just like anything else. It's an investment. That's why you're buying it. Don't get caught up in the hype or don't follow the trends. You know, there are certain companies that are trading at much lower cap rates because everybody likes them because they got a great press and great growth, but financially they don't make sense. So that would be my advice. If you're going to be successful long term, don't get caught up in the hype of the tenant. Really focus on the real estate.
Love that. Location, location, location.
Absolutely.
All right. Well, for those that want to learn more or connect with you, how can they find you?
Easiest way is actually through email, gpino@cbicommercial.com, or through LinkedIn.
Awesome. Love that. Well, definitely check out George on all of his adventures in the single tenant net lease world. And thank you all for watching. Make sure you check out the links in the description below. Give us a like, leave us a review, drop a comment, let us know what market you're in. And as always, if you like money and you like real estate, hit that subscribe button, and we'll see you on the next one. Thanks, George.
Thank you, Oliver.